Hello guys, and welcome back to Leah's Lifestyle. We're at it again with another Phill Town's Rule Number 1, Phill and Danielle Town Rule Number 1 podcast. We're on number 10. 26 is the magical number. So without further ado, let's start listening and see what they have to say.
Well, hi everybody, this is Phill Town.
And this is Danielle Town.
And we're here to talk to you
and
about
Leah Deering.
Rule 1 that Warren Buffett said about investing, which is don't lose money. And how do you go about doing that?
And how to integrate it into your life.
Yeah, we're going to integrate.
Yeah, exactly.
Yeah, exactly. And so we've been doing this based on these last few podcasts based on what Charlie Munger had to say, which I think is pretty awesome. He sat down with the BBC a couple years ago and said,
we keep listening to it over and over again.
Boom, 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 boom. It takes 1 minute, and we're going to run through them again.
This is the last time we're gonna hear Charlie,
This
right?
is it. I mean, we'll have Charlie talk to us again.
For this
But this-
particular
okay.
4
1 minute.
principle
Yes.
set.
So for
After
10 different
people
podcasts, they've
what are we on now?
played this the
100
same
times,
every
10
time.
times, 100 times, who knows?
The craziest thing about this is I sort of feel like we're in this sort of, Jiro does sushi sort of a movie where you keep doing the eggs every day for 10 years and pretty soon you really get it.
So we're
Yeah.
Jiro's son in this
We're
situation.
Jiro's son. We're 50 years old.
I think it's really important. I love that they're kind of making a joke about it at this point, but I agree 110%. You need to listen to it again and again and again. And once you can regurgitate it, once you can remember it, you can really start indoctrinating it and really understanding it. And I think if you, just because you hear it once, it's not enough. You need to be able to because that's how I felt, 4 years ago, 3 years ago, when I first listened to the books, when I first started paying attention to this, I was like, oh yeah, I'm really getting it now. I understand it. But then I could not tell anyone about it. I could not, get my mind to rethink about it and be able to share that information. It was very hard to recall it. But now at this point that I've spent 3 months, 2 months, wherever we're at, just repetitively putting it in my brain, I can actually have a conversation about some of this and sometimes it takes me a little bit, but I could actually pull out some of the verbiage and understand what I'm saying and be able to kind of put it into my own thought process. And I think that's really important.
Yeah, we're going to get our own restaurant.
We're just doing eggs. That's what we do forever. But
Just
by
eggs
God,
forever.
we're beginning to get really zen on eggs, man. And every time I hear this from Charlie, it's like, oh, there's another little opening up little wisdom chunk there.
Yeah.
So you keep listening because it's doing you good.
And since this is the last time, can you tell us who Charlie Munger is again?
Charlie Munger is Warren Buffett's 90-plus-year-old partner, who is the vice.
Which he's dead. Charlie Munger has passed. Warren Buffett just stepped down from Berkshire Hathaway. So we're moving on to the next generation of people being up there now.
Chairman of Berkshire Hathaway and has been forever, and who also runs his own fund. And
Which seems to be Manish Pabrai, Phill Town in Lilu, Lilu, yeah.
invests at a rate of return of over 20% now for about 60 years. The guy's a really phenomenal investor and a really bright guy, and
They
really
all
need
are,
to pay attention
honestly.
to him. He's one of the best, what we call Rule 1 investors in the world.
Cool.
Let's hear from him.
So he's on the BBC. This is on YouTube. You can find it under
Yep.
BBC Charlie Munger. It's, I think, the first thing that comes up.
And it's about 8 or 9 minutes of packed stuff. I mean, we're unpacking 1 minute
We're
of
just
it.
doing 1 minute. So here we go. Here's Charlie.
We have to deal in things that we're capable of understanding.
Capable of
then
understanding.
Once we're over that filter, we have to have a business with some intrinsic characteristics that give it a durable competitive advantage.
Durable
And then, of course, we would
advantage.
vastly prefer a management in place with a lot of integrity.
Great
and talent.
management.
And finally, no matter how wonderful it is, it's not worth an infinite price.
A
So we
great
have to have a
price.
price that
Good
makes
price.
sense and gives a margin
Four
of safety
things.
considering the natural
Margin of
vicissitudes
safety
of
price.
life. That's a very simple set of ideas.
So
And the
simple.
reason that our ideas have not spread faster is they're too simple. The professional classes can't justify their existence if that's all they have to say. I mean, it's also obvious and so simple. What would they have to do with the rest of the semester?
Who
Yeah,
knows?
it's also obvious and so simple that we've been unpacking it for hours.
Yeah.
And
10 podcasts. I have 4 books. Well, actually, this is only the second book. We have another book we'll be getting through. I can't wait to start it. I'm so excited. But yeah, and so many more books, so many more podcasts to be listening to. The information is ridiculous amount within the simple ideas. To fully unpack them, it's so much.
probably go on for a lot more hours, but we've got a huge amount of things to
And
cover
they
in this
do,
podcast.
right? Like I said, there's almost 500 podcasts, so we have plenty to get through.
Next 50 years. So we're going to have to move on a little bit at some point.
Well, he said, something I hadn't really noticed before. We were talking last time about the difference between value and price of a company. And I just noticed, listening to it again, he didn't say a word about value of a company. He only talked about the price.
Right, because the price is what you pay.
And
Price is
that's-
what you pay.
I mean, maybe it's more like
Yeah.
the first 3 principles are about value, and the last one is price.
Right.
Well,
Eh.
yeah, except you can't. Here's what you have to know. You have to know the value of the business in order
Right.
to know that the price you're paying is sensible.
Yeah.
And that's really kind of what he's saying. Is you can't pay an infinite price. You have to pay a sensible price. You
A
want a margin of
sensible
safety price. He said
margin of safety price.
But you can't get there without knowing the value.
Right.
And so you have to know
Okay.
that fundamentally what Charlie believes is that price and value are different things. That price is what you pay, but
Well,
value
price
is
and
what you
value
pay.
are different
and what
things.
Charlie's out to do is to get quite a lot of value for a very low price. And
Right.
in other places, you'll hear Warren Buffett talk about the simplicity of investing being simply to buy $10 bills for $5, and then you're certain to make money. And this concept that it's possible in the market to buy something for half of what it's really worth
Right.
is so foreign to the way
Even
people look at
now.
investing, the way your
And this
fund
is like
manager
10
looks
years
at investing,
ago,
the way
right?
your pension fund is managed, the way the SEC requires financial advisors to understand investing, all requires that if you're going to get a high rate of return, you have to take a lot of risk for it. Whereas these
you
guys are
don't
saying,
have
look,
to.
I can double your money in a year. All I have to do is find you a $10 bill and have you buy it at $5. And
Right.
you're going to double your money in a year or 2 years or 5 years, whatever. And you're hardly taking any risk at all.
Those guys who invest in other like non-Buffett styles,
Right.
they're looking at the backbone of a company as well, right? I mean, there's
No.
massive teams of research
No.
people who work for investment banks.
They're not
who
looking
are
at the
into
backbone.
companies and seeing if they are reliable companies or not. And their
But I don't
ratings
think
for
it's about
companies and-
money. It's
I mean,
about
they're-
whether or
it's not
not
like they're
people like
ignoring
them.
That whole side of things,
If they-
right?
Right. They're not ignoring that. You know, those guys.
I don't. I'm sure he's going to say something different, but I really do think they are ignoring it, because I do think that where they put their money is where they believe the rest of the people are going to put their money. I truly believe that the reason why they pick different companies like that are not doing Warren Buffett value investing rule 1, Charlie Munger kind of like investing, is because they're sincerely believe that it's better to follow along with where everyone else is going to put their money so that they can get that rise and then cut out. I really do.
Guys are really good at parsing out a company and seeing if it's wonderful or not. Where the rubber, or where the sort of car runs off the road for them, if you will, the reason that they don't beat the market for any length of time, almost any of them, is because they have to deal with such a short time frame. Warren Buffett and Charlie Munger's time frame is decade.
Right,
10
yeah.
years. I mean,
At
Buffett was
least.
on the air the other day talking about John Deere, and I think we mentioned this before, and he's basically saying,
Dude,
I
he
know
made
that in 10
fucking
years it'll be
so
worth
much
more than
money
it is
off
today.
of John Deere.
10-year horizon is infinity for your fund manager. He's hoping to be retired and sitting out on the beach in 10 years.
And he is now. That's so crazy. That's insane, actually, because this is the 10-year mark, and he fucking is. He made a shit ton off of the things that he, like, marked up there. They have, like, $500 million just chilling in assets to be able to put into something, so $20 turned into $250,000 in 5 years. Yeah. Damn. Did you were able to do that, or you found something that you could do that in? Or you've seen someone do that?
3 months.
That's,
3 months.
That's short.
Yeah, short. So
So that's basically from one quarterly report to the next quarterly
Exactly.
report, and they wait to see what the quarterly report says.
no, they usually are out of it in a month. Right? All they're doing is they're trying to catch a short-term ride. They call this momentum investing, and your fund managers won't admit to it, but it is exactly how they
Short-term
invest.
investing,
And in fact,
yeah,
an estimate
I
was
agree.
recently made that about 30% of the mutual funds are actually just shadow indexes. All they're
Shadow
really doing
indexes.
is buying
I
enough
need to write that down.
of the S&P 500 that if the S&P goes up, they go up, and if the S&P goes down, they go down, and they're just shadowing it. I mean, in other words, seriously,
Question mark.
a computer could do that. Right? No big
And
deal.
they do,
And you're paying
right?
them 1 to 2% a year for something that has
And that's the thing. I think a lot of the indexes and stuff, if you're hiring someone or you're paying fees to a brokerage to do anything with them, the thing is, like, I'm sure a lot of bots and a lot of code, like, systems are set up to just, like, run it for them.
pretty much no value, which is why the guy that runs Harvard's endowment fund said that mutual funds are the world's biggest scam. And we'll get into that maybe another time. But the problem that these guys have is that it's not that they want to be a scam or they want to be an index, right? They want to be active management and they want to show that they're really earning their money.
Right.
But the problem they've got is that the pension fund managers who put the money in the mutual funds will take the money out if they don't perform at least as good as the
Yeah.
market every month. They want to stay with the market. They'll give them 2 or 3
Which
months
is
of slack, but
insane.
that's about it. And then they start pulling money and moving it to a different fund manager.
That's
and
insane.
individual investors do very much the same thing. They'll look at Morningstar and they'll see, oh, who's got the 5-star ratings, And
Ew.
they'll move to the 5-star rating. And if it's not doing as good as the
Ooh.
market, they'll pull their money. And we're
doesn't make
full of
sense.
cautionary tales in our industry about don't try to be a hero and make your guys a lot of money. What you need to do is just stay with the index, because of guys like Julian Robertson and Warren Buffett himself have experienced the wrath of their investors when they have a year or two of sub S&P 500 returns. It doesn't matter how great you've done in the past.
That's crazy.
You have a year where you are not as good as the S&P and people start pulling their money. Even in
That would be like, getting, who am I trying to think of? Like, if you had a football or a basketball team, you had a basketball team and you had Michael Jordan on it, and Michael Jordan didn't perform well for a year or some shit like that, and you were like, oh, let's kick him off the team. Like, that's so dumb. If you had the best basketball player on your team and he just had a rough year, like, why would you, like, he's going to get better. Like, look at his past, like, so that doesn't make any logical sense to me.
individual investors, and even from Warren Buffett, which is why, by the way, I don't know if you ever wondered this, but Warren Buffett started off with the Buffett partnership which is basically a hedge fund.
I did
Back
know
in
that.
1955, 56, he raised money.
Recently
and
learned
began
about it.
investing as a partnership. And a typical, they called them hedge funds then, but basically he was one. And in late 1960s, he gave all of the partners their money back and said, go away. I am now no longer running this partnership.
That was after about 10 years.
Yeah, it was a little longer than 10 years. And what had happened is he had a couple of years where he had relatively low performance, like a 0% return one year and maybe 6% one year.
Okay.
And what
That's
the
not
reason he did
terrible.
is because he's not about to invest in an overly heated market
Right.
and put money into stocks that are overpriced.
Right.
And so he was just sitting on the sidelines mostly, and most of what he was doing wasn't making a lot of money.
Right.
Now, at this
Of
point,
course.
Buffett had made about 36% a year compounded for his shareholders for a decade.
Damn.
Per year. Per year. Now he has
Fuck. Could you imagine that? Could you imagine for almost 10 years you did like way better than almost anyone has ever done, 30-some%, and then you get 2 years, like 2 or 3 years where it's like 6 to 0% and people are upset with you? My guy, average that over. Like, why are you being upset now? Like, I made you that money. You think I just went stupid? You think I just went dumb? You think I just like, no, I know what I'm doing. You gotta trust
off the chart, right?
Trust your
I'm sorry, that
A
was
star.
during those 10 years.
Yeah.
You gotta trust your A
And
star.
yet he had a couple of years where he made 3% or 6%.
Yeah.
So
Which
he must
is-
have just killed it in other years.
Oh, yeah. He was doing over 50% a year the first few years.
Damn.
And then as he got more and more money under management, the returns naturally slow down because it's a
Yeah.
little harder to find good investments.
Right.
The more money you get under management, the more it affects your returns. So,
Of course.
So people started seeing that 3%.
And they
I mean,
said-
if I had my money with somebody who was getting 50% and then went to 3%, that would freak me out.
would it freak you out?
It would not
Because,
freak
and
me
it did.
out.
It freaks people out because they don't
You
understand.
wonder if he's lost his touch.
Sure.
You wonder if there's some new market
What?
forces he doesn't understand.
Exactly.
What?
And all of that comes back to
Why?
the individual investor, and even Warren
Why
Buffett.
would people question that? It's so interesting that she agrees and he kind of agrees with it, because the way I see it is like, if you like, imagine if you didn't believe like if Isaac Newton was around, right? And he fucking creates geometry, right? And then, he's like, for a few years he like disappears and isn't making too much, like isn't doing too much, right? Like, you just believe that now geometry doesn't work? Is that I'm sorry, what? Like, how does that make any logical sense?
Didn't really understand his investing strategy. They don't understand what we call Rule 1 strategy, which is to focus number 1 and number 2 and number 3 on just not losing money. That's the
Right.
focus. Like in real estate,
You don't lose money.
thing was location, location, location. Well, in Rule 1 investing, Warren Buffett style, Charlie Munger style, it's don't lose money, don't lose money, don't lose money.
Right.
So if
Don't
from
lose money,
Buffett's
don't
point of
lose
view,
money, don't
if
lose
he's investing
money.
in such a way that he knows he's not going to lose any money, he's doing it right. From the investor's point of view, they think, wow, you went from 50% to 0. You must be doing it wrong now. Something must have changed.
No.
So
Yeah,
they
maybe
challenged him.
So like Charlie said, we have to have a price that makes sense and a margin of safety as well. I would think
Idiots.
maybe he got the margin of safety wrong.
What?
Well, or
Maybe
he's
he got something wrong. That's
No.
what I'm
or
thinking.
he's sitting in cash. And the irony here is that every year Buffett writes this really complete letter that tells you exactly what he's done wrong
And we're
exactly what he's
reading
done right
those.
and where he thinks things are going, and he's such a good investor. You would think that with this level of transparency, people would have understood after 10 years what he's up to.
But no, of
and
course
that
not.
Eventually, the market changes and you get things back on sale again.
Right.
But they didn't, and it was, I think, very
That's
frustrating. to him.
insane.
He's never expressed this. It's not in his bio. It's just me as a manager of money putting myself in his shoes and thinking,
Right.
my God, what a bunch of ungrateful bastards these
Yeah,
people are.
that's
that
how
I've
I
gotten
would
this
feel.
Incredible rate of return. I've made
Yeah.
many of them very wealthy,
Right.
and now they're pulling their money out of my fund. Now they want their money back because I'm being careful. Are
Right.
you kidding me?
Yeah, it's
Keeping their money
entirely a
safe.
lack of understanding.
Yeah.
And a lack of faith. I mean,
Yeah.
that's somebody,
Yeah.
that's when he was
Exactly.
starting out. He didn't have 40 years of investing track record to point to at that
Yeah,
time.
but
He
10
had
years still is a
decade.
good.
years.
10 years
Yeah,
is
about a
still
decade
good.
anyway.
Yeah.
And my God, if you can't get it okay in a decade, So it's endlessly fascinating how people's emotions overwhelm their common sense, and their
A
emotions
lot.
took over in 1968, 69. And
Emotions
they started
are
pouring money. I
valid,
think
but you
frustrated
gotta-
Buffett. He's never said that.
gotta
Maybe
do a
I'm
little bit of
completely wrong,
this.
But I know he did this, as he said, here's your money back. And
Little
you can
thinking.
either invest with somebody else, go away,
Yeah,
or
like
you
fuck
can put your
off.
money with Bill Ruane, who's a friend of mine who invests like I do, but who's opening up a mutual fund, and he's happy to deal with your phone calls. And so Bill Ruane,
That's so
who's also a
crazy,
Rule 1
because
guy from
in
Penn-
our book we were just like learning about Bill Ruane. So I'm gonna write his name down here again because he's clearly gonna talk about him. And I want to make sure I'm learning about all the people who have invested, how they've invested, maybe some books that they've written, so we can read them. So let's see what he has to say.
who's trained the same way as Buffett, opened up the Sequoia Fund, which then became
Sequoia Fund.
one of the best mutual funds ever run by anybody. Long-term rate of return, I think, in that mutual fund for 30 years when Bill Ruane was running it was like 18% a year through the 70s, where it just went sideways.
Wow.
So the people who put their money with Ruane did well, And then Buffett said, or you can buy this stock called Berkshire Hathaway. It's like
Which is the
$10
one
shares.
he became
And
the
that's where I put in
shareholder
all my
of.
money, so you can put your money with me. But guess what? I don't have to listen to you anymore.
Yay!
Number one. And number two,
Fuck you
can
guys.
pull your money out of the company. You can buy and sell the stock, but the company capital will remain mine to invest. And that's what I want now. I don't want to have you redeeming your capital out of my fund right when I want to be buying stuff because it's cheap.
Yeah.
Okay, so we're no longer going to play that game. Now we're going to do Berkshire, and I'm going to run it the way I want to run it, and the way I need to run it. And of course, what followed from that is just history. It's just phenomenal what happened to those people.
Beautiful.
They compounded their money.
I wish I could
every
buy
3
into
years
it
then for the next 30 or 40 years. It's just like $10,000 became 40 million. So
I would.
It's, you know,
I would have.
that was better than Ruane.
I don't know if
Ruane
I
was
would
better
now.
than anybody else. And so whoever didn't put their money with Buffett or Ruane, you know, probably wanted to just shoot themselves 20 years later. So point being,
that's funny.
to go all the way back to the reason I started talking about that, is that fund managers know this story. They know that even if you're Warren Buffett, people are going to take their money away from you when you're sitting quietly in the market waiting for the market to get cheap again. The second story that I've got is Julian Robertson was probably the single most successful hedge fund manager in history.
Who?
Robertson invested from the 60s to 1999 when he quit.
Gotta go back.
Julian
Hold on.
Robertson was probably the single most successful away from you when you're sit quietly in the market waiting for the market to get cheap again. The second story that I've got is Julian Robertson was...
Julian Robertson, another investor, it sounds like, which we were going to want to keep.
Probably the single most successful hedge fund manager in history. When Robertson invested from the 60s to 1999 when he quit, he compounded money, I think, prior to distributing money to his partners at 38% a year.
Wow.
Crushed Buffett's record.
Oh, yeah.
He's a much more active investor, a little bit different strategy, but still, the cautionary tale was the same. By 1999, in spite of the fact that Robertson had turned in these unbelievable returns for 3 decades, people
So
yanked their money
30
out of his
years.
fund. Redeemed
That's
pension managers and all these guys.
insane.
Because why? Because he was basically sitting in cash, sitting back, waiting for the market to come back to a reasonable
That's
value.
crazy.
1999, it was an insane price in the market. That's when Yahoo was at 11,000 times earnings.
And look
people
what
were
happened
trying to
with
shove their
people
money
who
into
put-
tech stocks. And
So he
Robertson
saw
They
the
did to
bubble.
Yahoo.
Everyone else was freaking out saying, "Where?"
No one has ever, and no one will ever get their money back from Yahoo if they've ever put that shit in there.
These amazing high-rising
Exactly.
stocks.
Dead.
Oh gosh.
Exactly.
Dead.
And you know
Yeah.
what they did? They took their money out. And I watched him on television on CNBC just go, I don't understand what people are thinking anymore.
They're
So I'm
not
quitting."
thinking, they're feeling.
And it was a big deal because he's like the best. He's like the godfather of hedge
Wow.
fund managers. And he was
Wow.
quitting because of people's insanity.
That's crazy.
And they were taking their money out and they're making him look bad. He had to redeem stuff at a loss and all that. So he just went, I'm done. And
Yeah.
went off and just started investing his own capital.
Yeah,
so
I would have
these
to.
cautionary tales are not lost on your mutual fund manager.
These
The
people
mutual
trying to
fund
help
managers
everyone
discovered,
make
hey, guess
money,
what? I
and
don't have to be Buffett or Robertson.
people are like, no, you're
I can actually do
stupid,
better than them,
bitch.
not by making a higher rate of return, but by just shadowing the market.
Make
The
you
incentives are
38% per
extraordinary.
year.
The
Fuck
incentives
you.
are to have more money under management.
30
not to
years.
increase your rate of return.
Exactly.
I ain't stupid.
Exactly.
You're stupid.
And so
So the incentive is actually not aligned with the investor, with the investor who's investing in the mutual fund or the hedge fund or the pension plan, whatever. The incentives are misaligned there.
they are. And you'd think that, and they're misaligned because of the investors, not because of the mutual fund. They would all like to invest like Warren Buffett. It's not a secret how you make huge amounts of money with low risk in the stock market. But
You think
because the
so?
stock market thinks volatility and
I don't
risk are
know
the
about
same
that.
thing, if your fund is more volatile because you're sitting in stocks while they're going down and even buying more while they're going down, more volatile than a guy who's shadowing the index,
Fair.
they're gonna say you're riskier, and they're not gonna recommend you to their clients who are saying, "Oh, I want low risk in my investments."
Right.
It's so ironic. It's just mind-boggling.
I mean, this
But then I
misaligned
think
incentives.
that's the thing, though, is like those are the same people that are like the people who he's saying would want to invest like Buffett and everyone, but they can't because otherwise they look like low risk, are also the people telling people what low risk looks like. So they need to change the idea and the perception of what low risk looks like for them to be able to invest that way and actually make really good money. So that makes me feel like they don't actually want to invest that way. They would prefer to invest this way so they can make money while not having to worry about making money for other people, just looking like they're doing well.
Extraordinary to me.
Well,
And
that's
it's
my
the fault
perception.
of the investor.
Yeah, because they're ignorant, or they're being driven
And I agree,
by market
the-
forces of fear.
I agree. Investors can be really ignorant. I agree that they can but most people don't know what they're doing. So like if the person in charge of like the money says like this is what low risk looks like, and then they because of them sharing that information like that have to invest a certain way that is stupid, like that's their fault. You're the one that went to college. You're the one that knows how the things works. So I really don't know if we can blame the ignorant investor when the information they're obtaining is wrong by the person who's doing the investing. So I just disagree with that straight up.
losing their job. So you have two groups of investors: professional investors who run pension funds, insurance funds, banking funds, and who look to mutual fund managers and hedge fund managers as an outlet for them to invest. So they're kind of like fund of funds. You've got a big pile of money and you invest in people who run funds. And then you have individual investors who invest in mutual funds. And both of those groups are set up so that they're looking short term. Mutual fund investors get scared.
I don't drive.
If their mutual fund isn't doing as good as the market, and they'll pull the money out and put it someplace where it is. And more mutual funds have turned into indexes. And now I think people are starting to realize there's no real point in investing in a mutual fund.
Mutual
that's shadowing
funds
an
have turned
index
into
and
indexes. I want to check that out. Have mutual funds turned to indexes. I need that answered. I want to check that out.
Percent, just buy the index, and you get the same thing. And so more and more indexes are coming into 401ks instead of broad
Oh
market
yeah,
mutual
actually I do
funds.
know
Or buy a
that.
Vanguard broad market fund or something, and not pay all those fees.
401ks
so
are
that's
bad.
kind of happening just because people are starting to realize what I really want is just the market, because everything else is just too risky, too much volatility. I mean, there's so many stories about this. I can go on
But
and on.
things aren't
because,
volatile.
we sit here on the other side of this just saying
If they're
this is
picking good
insanity.
businesses,
The,
right?
the right way to invest is obviously the way Warren Buffett does it. You buy low, you sell high. Everybody
Right.
knows that.
Buy low, sell
But
high.
they can't do it because
Write it
investors
down.
will not allow you to buy low.
It's a little more complicated than that, right? I mean, you've said that you'll buy, let's say you buy low and then it goes lower, and you'll keep buying.
There it is. There's the catch, right? So if you sit in cash and then you buy low, and let's say you're buying a $10 bill at $5, and you're going, what a thing I'm doing for my investors. I'm doing this awesome thing.
Right.
I essentially just got them 100% return. I just don't know how long it'll take to actually go back
Right.
to where it should be, but it certainly is going to go there. And then it goes to $3. Now you can buy that $10 bill for $3. But the people whose money you put in at $5 have now incurred a marked, this is some Wall Street gibberish, marked to market, which means
Mark
they
to
have
market.
looked at the current price of that stock, and according to the current price of that stock, they've lost 40% of their money that they put in there. Horrifying.
I'm gonna look up that.
They're not excited that they can put in another
Mark
chunk
to market.
at a discount of 40%. What they're freaking out about is that their original capital appears to have lost money. And what they don't
Appeared.
understand is that price
Appeared
is not
to.
value.
Yeah.
If the whole time the value of the thing you've got was $10, then you haven't lost any money. At some point you're not selling it, so where do you lose the money?
Nice.
And you get an opportunity to buy more. So think of it like a garage sale, and let's say that you're an expert in mink coats. And all you do is you actually have a student who does this. She told me the story. Yeah, her whole thing is mink coats.
Mint
Oh, she makes a
coat.
ton of money on this
Mink.
politically
Mink
incorrect thing.
Yeah, I don't like it.
coats.
Oh, it's very smart when you think about it. Just
Because most people start investing is pay off all debt and credit, mortgage. Oh, I don't have debt, credit, mortgage. I don't have any of that. No.
from a money, forget the values for a second, which you can't forget. You have to connect values to money. But for her,
But I
it's no
agree
big-
with you.
she's fine
That's the
with it.
first thing you should
So,
do.
Think
Oh,
about it. It's a
but it kind of depends. If you have debt that's like under 10%, under 5%, then it's not as necessary to pay it off because you could invest that same money that you'd be paying that off in something that could give you 15 to 20%. So it kind of just depends.
politically incorrect market. So there's a lot of emotion connected to owning a mink coat. And as a result, people will put
But I do have to say most people don't have debt or anything that's underneath that percentage. I did, by the way. I made sure when I went to college that the percentage that they had for me was at 4%. I was like, lock that shit in. I don't want it changing. That was the best thing I could have ever done.
$1,000, $10,000 mink coats in a garage sale and just get rid of it.
Yeah, because you don't want it.
And you feel a little
And you
like,
feel yucky about
I don't
it.
really want to sell it.
Mhm.
I'm not going to really defend
Although there
it.
is a whole school of thought that if it was already made and it's vintage,
Mm.
then it's what can you do? Poor
Yeah.
little animal.
Yeah.
You know, nothing you can do about that. You might as well.
And
burn it.
honestly,
I'm
yeah.
not saying I ascribe to that school of thought, but it does exist.
Well, this girl is like, hey, I'm
I subscribe to that thought. If something's already made and like it's already in and someone's like selling it and you want something really nice that's already lasted a long period of time, I don't see why you wouldn't get that better thing. I don't actually own any fur coats, but I also don't think that like the opposite best to that is buying a new fur coat. Like that's like what is it, faux fur? Because faux fur is just as damaging as normal fur, truthfully. Like the plastic does just as much. There's not a good alternative to plastic for faux fur yet that I know of. Last time I looked into that was like 5 years ago, so that could have changed, but
good with it.
depends.
That's fine with my
Everything
guys. I wear a mink
depends.
coat, right? And so she's she's out there looking for this thing that's got a lot of emotion connected. And when there's emotion connected to it, people will price it irrationally.
Mm-hmm.
So instead of selling this $6,000 mink coat on eBay and getting it to somebody that would like it,
Mm-hmm.
people almost refuse to sell it. They just give
They
it
want
away
to keep
God,
it.
yeah, it's like blood money.
Just keep it
to some people.
to some
I'm
people.
just saying, you have to apply your value. I'm not going to get into my values.
All
on this.
right, all right. I'm blown away by this. I didn't even realize there was a whole eBay world of terrible coats being sold. But
Terrible coats.
But there certainly is. There's a market in mink coats.
like
Absolutely.
There is a
Market
market in
share,
it.
okay.
Yeah,
Okay.
there is.
all right, I'll
All right.
stop.
So I'll take the other
She's
side of that.
connecting the emotion to the product.
And so she goes out, and so think about what she has to do in terms of what Charlie Munger has just told us.
Mm-hmm.
Is she capable of understanding the industry she's in? So let's think. Can she figure out the difference between a real mink coat and what it's worth than
Mm-hmm.
one that's a fake? In between two mink coats, does she know which one's 6,000 and which one's 800?
Right.
Okay, retail. So she needs to understand that part of the business, and she also needs to understand
Yeah.
why would these be on sale? What's
gotta
the event
understand
that
the
put this on
business.
sale that made it emotional?
Mm-hmm.
And so she understands that because she
Mhm.
knows that mink coats politically incorrect. A lot of people are getting rid of them because they don't like the idea that
Right.
mink animals are being killed to create this coat.
Right.
Okay, so she understands why it's on sale. She understands the business. She understands the difference between a good one and a bad one.
Okay.
Perfect. Now, she goes to this garage sale. She looks through all the stuff, and she finds one that's $6,000 retail value. That's what it originally sold for.
Mhm.
And the people here want $100. She pays the $100.
That's a
takes it
good
to eBay and
price.
sells it for $1,000.
Yeah.
So let's look at exactly what her risk is. According to the efficient market
That's a
theory,
good- that's
that
a
should
good
never
point.
happen. No one should be irrational enough to sell a $1,000 value for $100. No one
But
should be
they
that
do.
irrational.
But they
But
do.
you're sitting there just going, yeah, but I would.
Yeah.
I mean, it sounds kind of efficient to me.
Yeah.
I mean, how efficient is that? They literally gave away $900. All they had to do was put it on eBay.
Right. I mean,
Yeah,
I guess
but-
the internet is what makes that inefficient, because without the internet, you wouldn't be able to find the market of the people who want to buy the mink coats.
The market's quite
Well,
efficient. There's millions of people out there on the internet, on eBay, buying and selling all the time.
That's
It's
what
a
I
very
just said,
efficient
without
market.
the internet.
Oh, okay,
Oh,
without the
without-
internet,
Yeah,
it'd be less
the
efficient.
internet makes it possible to have that efficiency. because
unless you
can find the
know
market
the
for this
community, right?
Right. So it's made
torturous
it
device.
it's made it more liquid and more efficient and more information and all that.
Yes, it has.
But still, the fact is,
It's
that
getting more
these
and
people
more.
are reasonably intelligent people. They know the internet exists. They know eBay is there. They know they can put it on eBay, and they just don't
Yeah.
because of emotion connected to that code. And so this
Yeah.
very thing, this is a really good metaphor for what goes on in the real markets. When BP's well broke in the Gulf of Mexico,
Okay.
Condo well, tremendous amount of negative emotion and political correctness came flowing into the market around the Gulf of Mexico oil drillers,
Right.
and they all went on sale. Like even
Which
if they
is
didn't have
so
anything to do
weird,
with that specific well,
because
you could
we-
buy a really good, the safest well drilling company in the country, and at that point in time was probably Noble Corporation, and they went on sale. You could buy this company for like $30,
Damn.
$28.
Yeah,
Damn.
everybody suddenly became extremely aware of the risks
Damn.
of oil drilling in the Gulf of Mexico.
Yeah.
The risks were there the day before,
Right.
and they were there the day after, and they were there a week before and a week after.
Yeah.
People just
Years
became aware of
after.
them. And
Yeah.
that's what caused all the selling.
Which is crazy.
And the emotion of being
And even still,
involved in
honestly,
something
even
that-
still that people understand like the risks of oil, like we still all use oil all the time. It's still a big thing. Like we're seeing what's happening with the Strait of Vermouth and everything like that. So it's like even before, like, this happened way before that, and like we see oil spills all the time, and like now I guess because of the oil spills we probably see less of like a rocket from them because we kind of got used to it. We got numb to that experience. But yeah, when something first happens and like people weren't really aware and stuff like that, like they kind of took a while.
It's politically incorrect. It's very politically incorrect to pollute the Gulf of Mexico and drown beautiful birds and make a mess of people's businesses, and all of that's massively politically correct. And so all kinds of people were basically calling their fund managers, who don't have a moral bone in their bodies when it comes to the money they're investing, and saying, "Are you in BP or RIG or?"
Isn't that exactly what you've been saying? Is that people should invest according to their values?
Sure. And
That's
so
what those
people
were doing.
Absolutely, and it created an enormous amount of emotion in the market and fear, right? So as these guys started saying, "Hey, get out of there," more people sold, and now you have the situation like a crowded theater that people are smelling smoke in, and the first people to the door are going to get out.
Yep.
The last people to the door are not going to get out, and everybody
Yep.
knows it. And so the fund managers, you need to know something, by the way. These guys can't just exit a position. By these guys, I mean the people who have institutional sized money.
Right.
When they
Billions,
try to exit
millions of
BP or
dollars.
Transocean or Noble,
Yeah.
if they took their money out all at once,
It
it would crash the stock.
yes, it
and they
would.
be unsuccessful in getting their money out
Yep.
at the price they thought they could.
How
Yeah.
much money middle of the road?
They can't just take it all out.
Institutional investor. Man.
Unlike us, right? Like if you
you
only
know-
have a few $1,000s in there, a few $100s, like you can exit it really fucking quickly. They'll just give you your money and let you go. But like, yeah, if you have billions of millions of trillions of dollars in the company, you cannot just fucking rip that shit out and be like, thanks, bye.
Medium-sized fund.
The same thing with penny stocks. Like you can like hype a company up by throwing a bunch of money in there, throwing it on the internet and being like, oh, buy in, hype that shit up. And if you try and pull all your money out, that company is going to be like, well, we don't really have that. we can't really just give you all that money. You would fucking kill our company.
The institutional funds, let's say, are roughly 700-800 million to $1 billion. The bigger ones, Fidelity, Magellan, these guys run upwards into 15 billion. Some really big ones like BlackRock, they're managing $1 trillion.
And how much money, again, middle of the road, total gas, would they typically invest in one company like BP?
Well, they're usually going to be in for 1% or less. Typically they'll have 100 companies to 200 companies in their portfolio, and therefore any one company is a very insignificant portion of the portfolio. But because they have such a big chunk of money in it, it's dozens of millions to hundreds of millions, that 1%. And so when they start pulling it out, it can be quite a big chunk of that day's trading, and the market feels it. And
Yeah.
so when it feels it, everybody starts to accelerate and get out ahead of you because they see this
So
block
true.
of money coming in. So these guys have built computer programs that will do the trading for them and try to get them out at the best price. But Bill Nygren over at Oakmark Select, which is medium-sized mutual fund, Bill said takes him 6 to 8 weeks to get out.
6 to 8 weeks.
And that's when there's not a panic going on.
Ooh.
Oh man, when a well's broken and it's spewing oil, that's forever.
Yeah.
The
Damn.
price is dropping $1 a day, $1 a day, $1 a day, $1 a day from 60 down to 30. Oh my God, man, it's
Ooh.
like a nightmare. And so if you accelerate, you're selling, you accelerate.
But if
the
you
price
think it's a
drop,
good
right? The
a
more sellers are out in the
company,
market than buyers.
damn.
There weren't a lot of buyers out there for BP stocks. So the price is really plunging.
But it
And
matters
becomes
'cause
very
for-
emotional. You're sitting there just going, my God, I had a really good year going, and all of a sudden a chunk of my portfolio is getting crushed.
right.
So
Okay.
you
Because
can
they
see
care
the
about
emotion builds
the-
up on these guys, and they
the way
they start
more
to
than they
feel
do
like
about if
somebody
the
in
company's
theater
good or
trying to
not.
get out that door.
I take your point that there's some emotion. I'm not sure it's all emotion. I mean, there was a lot of new information that came up, and you talk about events happening. I think that was probably an event that could maybe make you change your opinion of a company.
Right.
I mean, there was a huge lawsuit coming out of the government that has gone on for the last however many years. Nobody knew how that was going to come out. We still don't. I think. Actually, I don't know if it's been resolved or not.
Well, they've hammered him about as hard as they
Yeah,
can.
they got fined, I think, but
Yeah,
I
of
remember.
course they do.
The point is,
They
there
fine
was a lot of
everyone. They're like, oh, that's
uncertainty
good
and a lot
enough.
of,
Clean up as best as you
consequences that were
can.
going to come out of that oil spill, and nobody knew what those consequences were going to be. So, wouldn't it be reasonable to change your opinion of a company at that point and maybe sell?
Well, it certainly would be reasonable, particularly if you're in it at $60 a share and you knew it was going to drop like a brick. Why take the
yeah,
loss?
right.
If you know it's going to drop like a brick. So even I think if you have the liquidity, like Warren Buffett said, he'd love to be able to get out of Coca-Cola.
Yeah,
when
but
the
now
price is
those.
dropping to
Here's the
$40
crazy
a share or
thing is
something.
like
But
now those companies are at 100. So if you would have kept in, let it drop, buy in even more at the 30-20%, and now you're at 100, you'd have so much money to buy out right now.
wasn't nimble enough to do so.
Did you just say that you should sell when the price drops?
Well, when you've got a big change in the story, then I
that's
think
what
you
I meant.
got to
Yeah,
reevaluate.
that's what
Right.
I'm asking
Yeah,
about.
you
When
gotta
the-
reevaluate
with
New
the-
information
yeah.
that changes the
If
intrinsic
the-
characteristics of the business.
Right. If the business, if you can tell that the business is no longer a wonderful company, then yes, you should. Even if it's dropping, you need to get the fuck out, because if you drop to a point, you might not ever want to pull out, because then you just you would not get anything. You'd be negative.
just the management
Right.
changes your understanding of what that company's all about.
Right. And even if you have something that doesn't change the long-term intrinsic characteristics of that company, which I think was the case with BP, still one of the greatest oil companies out there. If you like oil, it fits into your value set. That's a great company. I mean, they're the best exploration production company in the world, in my opinion. They're better at it than anybody at going into hard places and finding oil. And so there's only like 3 or 4 companies they compete with in the world at the level that they're at. So this is a fantastic company if you're comfortable with their industry. So the long-term intrinsic characteristics that make them fantastic hadn't changed a bit that day. They were going to be there. The big question is would this bankrupt them?
Exactly.
That's the question. And Jim Cramer was on going, hey, this is going to bankrupt these guys.
Yeah.
Get clear of it. And so here's really something interesting about market pricing, I think, is that you can have a market price that's dead wrong, and everybody knows it.
Yeah.
And yet that's the market price.
Yep.
Because pricing is a war between those people who think it's going to go up and those people who think it's going to go down.
Yep.
So BP went from like $60 down to $27 a share. Now think about this. At $27 a share, pretty much everybody involved in that stock agrees that's the wrong price.
Right.
At $27 a share.
Right.
So people can get together, have a bloody battle over what the right price is, and have it be exactly the wrong price, and everyone knows it, and yet that's the price.
Yeah.
Just think about it. If the guys who think it's going to go bankrupt are right, then the price is 0.
Right.
Right.
And if the guys who think it's not going to go bankrupt, then the price is 60. It doesn't have
Yep.
a long-term problem. What it isn't is 27. Everybody knows it's not 27. Okay?
Yeah.
So that, by the way, creates real opportunities for us with our options trading, which is something we can go into someday way down the line. But in
Options
general, just
trading.
looking
That's
at
the thing
this,
that I learned a bit about. I'm going to just write a note here so that way I can remember options trading, which is something I've done. Options and
marketplace,
puts.
if you are in a company at $60 a share, and let's say you think that that's a reasonable price for BP, that's intrinsic value. See, our model is we're out at that price. We're going to buy it at a margin of safety price at, let's say, a $10 bill at $5. And when it gets to $9 or $10, we're a seller. We're looking to continue the volatility of our money and move it someplace else. If we've got a good place to put that money when it's back up to 10 and we've doubled our money, then we're going to probably move it to somewhere else. And this is very much Warren Buffett 101 back in 1950s, 1960s, 1970s, before he became so big that he can't do that.
Yeah.
So as a small investor, we still can.
Did you just say you would sell when the price goes down?
When the price goes up to its retail value, then we're probably out.
Oh, you would sell when it goes up.
Yeah. So in other
Yeah.
words, we wouldn't have been in BP at 60 in the
Right.
first place.
Yeah.
Right, because it's all the way up there. And
Right.
if we were, let's say it was 3 days before we were deciding, okay, this
I
is
should
gone
check
from
out
whatever
BP
to
too
now.
and see
So
what
you think
there's at.
60 was too high of a price?
No, it's a real fair price.
It's
That
a
was
fair
a fair
price, but
price.
it didn't have a margin of safety?
Right.
Okay.
No margin of safety. So now it's only going to grow at the speed of BP, whatever BP grows at. The growth rate of BP is how fast my money will grow once it gets back up to its intrinsic value. And since BP is growing at maybe 7 to 8% a year, that doesn't anywhere get near our required 15% a year. So at that
Is
point,
the growth rate of a company different than our return as investors?
massively. Whole different world. Those are apples and oranges. And it's funny you
Okay.
mentioned that because people get confused about this all the time and think
Alright.
that your rate of return is somehow connected to the growth rate. And that would be true if all prices are equal to values.
Yeah, exactly.
Right.
Exactly.
Then the fastest you can grow the new price of the company is by growing the value, and the value only grows by growth rate. So therefore, you can't get a different rate of return than the overall growth rate of the company or the market.
It
Whatever
would be
you invest in.
impossible.
Would be impossible. And so
I just said rate of return and growth rate are
growth
not the
in
same.
Rule 1 investing, growth rate and rate of return are completely different because we're not paying what the business is worth.
Yeah.
Wouldn't that be true in any kind of investing?
Eh.
No.
If you purchase it at a lower
Oh, yeah,
price?
yeah, yeah.
If
And
you're
you
purchasing at a
buy it
lower-
much
yeah.
less than the thing's worth, you're definitely going to have a higher rate of return than the
Right.
growth rate of that market.
There's not a magical,
Right.
It's not a magical
rule
thing.
one.
But the problem is when almost every other kind of investing that I can think of that's not businesses,
Right.
it's hard to know what that number is. What's the real value of gold? What's the real value of
Yeah.
Picasso? I don't know.
What's the real value of
That's gotta be-
Picasso?
Right?
A commodity that's just traded on a market.
Yeah.
Right.
But a farm, that's going to produce cash flow. And if it produces cash flow, I can figure out pretty much what the value is worth. And a business, so farms are businesses, apartments are businesses, right? That's how we look at them. We don't segregate between these groups, they're all just businesses. And if you can buy a business at a significant discount to its real
Cash
value,
flow
based on
equals
its cash
value
flow
of
in the future,
business.
and the amount of risk you're taking to get that cash flow, you're golden. So
last time we were talking about a business that I think was growing at 10% a year, and we were trying to get 15% a year return.
Right.
And it was a little confusing with all the numbers, how exactly you do that. But
Well-
basically, I think it sounds like the answer, tell me if this is right, is that you just simply purchase it at a lower price than its value.
Right.
And that's how you create the extra returns.
that's right. So
Right.
let's go back to our $10 bill we're buying for $5.
You find
So
out what the value
Our
is,
rate
and
of
then you
return
purchase it
is
underneath
the
that.
amount of money we get
Create
on
the
our investment,
15%. That makes sense.
and with time as a factor, right? So we want to look at it on a per year basis. We call that the CAGR, C-A-G-R,
CAGR.
compounded annual growth
I
rate.
was thinking of a different kind of
Exactly. With the Wall Street term, CAGR. So compounded annual growth rate. That's the key number we want to know. So if we were to buy a $10 bill for $5 and we could sell that a year later for $10, then our CAGR is 100%. We just made a 100%
Okay.
per year rate of return. Okay, a lot higher than 15%. So 15% is our minimum acceptable rate of return. That's
Okay.
not our target. It's just our minimum on how we
Minimum.
value something. Our
Okay.
actual target, and you might want to write this down out there,
Okay.
is 26% per year. That's our target.
26%
That is a very detailed number.
Oh yeah,
per
Why not
year.
25? Why not
25?
27?
Not 27.
Is
It's
our
26% per year. In fact, one of my favorite investors to study
target,
is a
not
wonderful hedge fund manager
15.
named Monesh Pabrai, P-A-B-R-A-I.
That's
If you want to learn Rule 1 investing,
minimum.
he's your guy. Okay, he wrote a book called Dondo Investor, D-H-A-N-D-O.
Yep.
Fabulous book. You've
Well,
got to read this.
I'm gonna
book,
rewrite that
seriously.
down, but
If
we
you wanna
already
learn
have
this
it
kind of
down.
investing. So
Okay.
Monesh has 26 on his license plate.
So we're just copying him? Is that where you got that number?
Oh yeah, Monesh got 26. Buffett should have 26 because that's target number 1 is 26. Munger should have 26. Graham should have 26. We're all targeting that, and the reason is because that magic number 26 represents the compounded annual growth rate, the CAGR. If you buy a $10 bill for $5 and sell it for $10 at the end of 3 years.
Oh. All right.
So the goal is that we all have Monesh, and he's just
So
made
100% return
CAGR.
over 3 years.
100% return in 3 years is a 26%
26%
per year
compounded
compound annual
annual
growth rate. And Monesh has made that more explicit than any of the rest of the Rule 1 guys. Buffett just is like, hey, I'm going to buy a $10 bill for $5, and someday I'm going to make money.
Well, 3 years compared to what you've been talking about sounds like short term to me.
Well, we are a long.
but we're doing- yeah, we're doing it by years, not months.
The right time to sell a company is never.
Right.
But in actual practice, he sold a lot of companies, especially back in the 50s and 60s and 70s when he had that kind of liquidity and he could move to another one.
I'm grateful that you haven't missed a stream. I appreciate it.
Sold. But the ones that he's held onto long term have intrinsic characteristics that keeps them growing really consistently out into the future.
Right,
So I
which is
think
what
he
we
just
want.
doesn't have a better place to put the capital because he's got so much capital in there. Right.
Right.
Really hard to move 10% of the market capitalization of Coca-Cola into something else.
Yeah.
And so he just leaves it there.
Joke.
But for us,
Yeah.
as small guys, we can move it. So
Mm-hmm.
for us, what we want is we want to buy this thing on sale, and when it goes back to retail, we're selling.
Right.
And this is how we keep what we call the velocity of money high. What we're targeting
Velocity
is 26%
of
per
money
year,
high.
and we're doing that by focusing on businesses we can buy at a big discount to their intrinsic value that have some sort of catalyst that's going to take them back up to their regular value within 3 years that we can see in the market. And you know what? Most of the time, that's what happened. Mr. Market is not stupid. And
No,
it
it's
doesn't take
not.
him that long to get over some brain dead activity where he sold stuff super cheap. And when he gets over
Aw,
it, those
thank
things go back
you.
up to their real value.
You said a couple of things. One is retail price.
Yeah.
What's that?
Sticker, intrinsic value,
Yeah,
what it's worth
sticker.
as a business in the
Retail.
public market. That would be the retail price.
Mm-hmm.
Oh, okay. So that's just kind of like a Rule 1 term.
Yeah,
Retail price.
retail.
Retail.
Okay.
Okay.
We want to buy wholesale, essentially.
We're buying
We want to buy
wholesale.
wholesale, sell retail. And this is so important. I think we ought to spend some more time
Oh, I'm going to
On
write
retail
that.
price?
on retail pricing, on wholesale pricing, on buying 5s and selling for 10s. How much of your portfolio should you be putting in one kind of thing? How long
Buy
should you sit in
wholesale.
cash and do nothing? All that kind of stuff is really important and related very much to this whole
Sale.
concept that Charlie's talking about buying things on sale. So I think we ought to come back to this. I just don't think we have enough time to get into it right now.
Retail.
Yeah, I think that sounds like a whole series of podcasts maybe where we talk about it in detail.
Yeah, I think we should dive into that. I think it all focuses on this basic concept of not losing money, which is Warren Buffett's
Yeah.
rule number 1 for
Don't
investing.
lose money.
And he said there's only 2 rules. Rule number 1, which is don't lose money, and rule number 2, which is don't forget rule number 1. So
Don't
for
forget
Buffett,
that rule number
it's
1.
all about making sure that your
Save that
focus
money.
is on the downside.
Yeah.
And that's what we're going to talk about. I'm going to talk about that in terms of the way Monesh Pabrai looks at it, the way Buffett looks at it, Munger.
Okay.
And let's get into that next time. You want to?
Yeah. So you
Yeah.
think we're done with Charlie's
That's so
quote
cool.
there?
We're never done with
Well,
Charlie's
we're
quote.
never done.
Never
We
done
can
with
use
Keep
Charlie's
mining
quote.
that quote, and it's 1 minute.
Mining
Charlie.
that
Yeah,
quote.
I think let's
But I
go
don't
to
think
Such
we
a
need
Buffett.
to
weird
play
way
it
to put
anymore
that.
for everybody.
Let's play Warren next time.
All
I'm
right.
going to play that quote for you
Ooh.
for rule number 1.
All right. So just to wrap up the Charlie Munger 4 principles. I mean, we started out talking about how you even start researching a company. which
Yeah.
I admit I have not started reading Barron's, but I will. I need to download the app.
We can certainly come back and add a
We're
little color to that
reading.
little
We're
bit,
reading
because
lots,
that's-
aren't we, guys?
Yeah.
Right.
Yeah.
So understanding the business is.
I'm
you gotta
excited
be
for the new
capable of
book.
it, and you gotta
After
know what
next
your
month,
limitations
after
are, what are
next
the walls of
week,
your
we'll
canyon,
get a
stay
new
within the
book.
walls. And then you got to make sure what you're really doing when you're researching is finding a company that has intrinsic characteristics that give it a moat, that give it protection for the long term. And the reason for that is so you can figure out what it's worth, because businesses are just worth the future cash.
Yeah, they are.
Discounted to some price of today. And then you'd love to have really good management, but you know what? If you've got idiots running the company, that's okay, because you know why? If that company has a really structured intrinsic characteristics that give it a big moat, even an idiot can run it.
Yes.
And so Are you puzzled by that? Buffett said
We spent hours talking about how important management is.
it's critically important,
Management's
but
so
idiot
important,
guys
yeah.
won't last long. We'll get good guys in there. The key is that the business can survive while idiots are running it
Yeah.
because it has such good intrinsic characteristics.
Yeah.
So we want
It's
not
like
idiots.
the opposite of a profound
We
truth
don't
is
want
also
idiots,
true.
but
You
sometimes
need
that happens.
Excellent
Not
people
all of us
full
can be real
integrity
smart.
running your company, but if they're terrible,
Not
we
all of
respect
us
you.
can't
If
be
it's
greedy.
terrible, the thing that the moat protects you. So if you got guys running it who decide New Coke is a great idea, the intrinsic characteristics
Which
of Coke
happened?
protected that
Which
company
happened? Do you
so
guys
that
remember
could be
New
rebuilt.
Coke? That
And then
really
we need to buy this thing
fucking
at
fucked
a
with them
sensible
for a
price
while.
that is discounted to a
They
market
fired that
system.
man so
Those are
fast.
Charlie's basic principles, which we can unfold here for years. They're so deep.
That was funny.
Which of course he says are so simple that a professor could only spend one class on them and then have nothing to talk about the rest of the semester, which is not quite the case. I don't think. So
But
I think,
the
that's it for
simplicity
Charlie
of
for
it
right
is
now,
what
and
he's
then we'll
talking
come back
about.
with Warren next time and start unfolding this idea of
That would be
don't
cool.
lose
I
money,
can't
which
wait to see
because
what
you
they're
were
gonna
just
say
saying all
with
your friends, when
Warren.
you tell them that, do what?
They roll their
They roll
eyes.
their eyes. So let's take a look at what that really means.
Yeah, it means nothing.
Until next time.
I expect that Phill
That was pretty great. That was awesome, guys. Okay, if you're watching this on YouTube, don't forget to like, share, subscribe, leave a comment down below. Now that we've gotten through 10 of these, and apparently we'll be moving on from this one little section that we kept like hammering in, how do you guys feel? Do you feel like you've really gotten it into your mind? Are you ready to like share it with other friends and see if you can like have a conversation about it? Leave the comments down below. And until next time, guys. Bye.